I want to talk about the indicators of the strategy, which is great for trading. For beginners, traders, also for experienced traders, it has a rather interesting principle of operation, and it is built on a combination of 3 indicators, a combination that you rarely see, because the strategy has come up with quite a few moments of accounting for the long-term trend, accounting for market volume, and so on. This is a trend strategy and is well suited specifically for finding short to medium-term trends. But in general, it can be used for long-term trends as well. It generally performs well during the summer as well. So let's move on already to the description of the strategy. So we will need 3 indicators for trading. The first indicator is exponentially moving averages. We add whatever color you like to the chart and put a mandatory period of 50 applied to the close. We set our averaging to exponentially moving and put the line on the chart. Here we have it added. The moving average shows us the average of the last 50 candles. As a standard rule of thumb, when we have a chart below the long-term moving average, it is a signal to trade down. When we have a chart above the moving average is a signal to trade up. How is exponentially different from normally? The exponentially high importance placed on the last colors. That is, if we put a simple sliding, exponential sliding on the same chart, it will react to a drop and a sharp rise in price. A little bit faster, a little bit sharper than usual moving averages, because it is the last candles that matter to her. They take up more space in the calculation of the average. So the next indicator you will need to trade is momentum. We have the moment. It's an indicator. It's an indicator from the group. First, like many other stimulants like rice or statistics, it measures the difference between the current price movement and the average of the previous price movement and indicates whether there is a bullish or bearish moment in the market. I mean, what is a moment? Is it a sharp downward or upward price movement? This is the moment when liquidity comes into the market in one direction or the other, and we can open and take advantage of that momentum and open a trade in one of those momentum sides. This is a regular scale that has a 0 value. It is an equilibrium between buyers and sellers. 0 value. If we have a chart in the negative zone, it means that there is a bearish momentum in the market, and it shows a preponderance of volume between sellers and buyers. You see, the value here averages from 0 to 4,500. This is the number of lots and items that there are now more sellers in the market than buyers. And similarly with moment 5, a moment when the moment is above 0. So there's a buying moment in the market. What do we have the advantage of buyers over sellers? We have a sudden movement. And the deeper the indicator of this moment, the farther from 0, the stronger the signal for a deal. But both of these indicators for us will be like this. They will only confirm the signal on the main trading indicator in the strategy. And the main indicator for our strategy will be the Supertrend indicator. This strategy I'm telling you about comes in 2 variations. One is built on the usual Supertrend indicators. The second one is on a Supertrend that is super trending. Another indicator we will use is the classic Supertrend, because it is available in any terminal, including the HashHedge terminal. And so the Supertrend indicator looks like such a curve, which is colored green or red, according to its working principle. It looks a lot like a ship. When it is green and below the chart, it is a signal for an up trade. When it changes color to red, it is a signal for down trades. What's more, here you see that. In the case of a down signal, the chart is above. The indicator is above the chart, and the signal only changes when the chart directly crosses the trend line. Also, but unlike the same, here as you can see, there's accounting not only as a moving average system. There are periods of horizontal movement. It also takes into account local highs and lows. In general, the indicator of a rather complex calculation formula, but that the main principle that we need to understand that when the chart needs to, that when the super trend is above the charts, it's red, it's a signal for trades down. When the trend is green and it's below the chart, it's a signal for trades up. And according to this principle, we will receive the main signals on our strategy. So now we go directly to how to use our strategy. we can spin off to a random moment in the past and try to see how it worked in history. So the first thing we look at, as I said, is the Supertrend indicator. If it changed color to red, this is now the signal for a new deal. Here, for example, in this case, we use our two indicators after that. First of all, the moving average. As I said, as a general rule of thumb, the chart should be for a down trade, should be under the 50 moving average. And for up trades, it should be above the 50 period moving average. The second filtering we have is by indicator, moment, at the moment of opening a deal. The moment the trade starts should be in the negative zone for a down trade, and in positive territory for an up trade. Let's take these three rules as an example. Let's say we had a moment here. There was a super trend of green. It changed its color to red. Now we have a signal for a trade down. Next, we check against our two indicators. Here's the color change of the super trend. The super trend gave a signal at this point. Here we have a candle, and it is below the moving average with a period of 50. That is the first confirmation there is a chart lower than the moving average 50. And at the same moment in time, we're at negative 738. So it's negative, and it means that we got confirmation. Right here, we enter the trade down. Look further. At this moment, the indicator shows green color. It shows a signal to buy. At this point, we have a candle above the 50 moving average. So we have a second confirmation of the moment. We have a positive, small, but positive. We can at that point trade up and make a profit. Watch the next signal, the trade change color to red. Super trend change the trade to red, shows us the signal of the trade down. In the candle, at the moment of crossing, we have under the moving average 50 moment negative. We may have made a small profit here as well. Note a very important point. While all the indicators used here are trend indicators and the strategy trends in general, but here on this stretch, which is fleet and pretty narrow fleet, we have three good trades that would make us a profit. The latter is debatable. That last one would probably get us plus minus zero, but on average, we have more positives than negatives even on this movement, and so on. We can further validate all our signals using all our usual rules. Here we have a super trend, again pointing to an up signal in green. We have the chart above the moving average. Here we have a candle, sure, moving average, moments in the positive zone and quite high. As you can see, there's a sharp movement here, and immediately the momentum we have shows a high value. This is if you have more than 1,000 at the moment of making a deal, it is already a signal that there's a good movement in the market. When you have more than 2,000, it means that you have a strong movement in either side. This only further confirms our signal. Such a simple strategy, it can generally be used on a variety of assets. It performs well on both assets that lean more towards the fleet and assets that lean more towards the trend. Excellent performance in volatile assets, such as cryptocurrency and on conservative assets. Overall, the return of this strategy, if you look at the tests, is more than 70-80%. Very good results. And it is quite simple. Here it is good for beginners that we don't have signals that can be interpreted in two ways. We have a clear signal from each indicator, a clear condition that must be met to enter a trade. And as for makeup, optimal for working on this strategy is 1 o'clock. In my opinion, you can also try 15 minutes for those who want to get more trades, but their quality will be a little worse, or try 4 a.m. for patient traders who are willing to wait for trades, good trades a little longer, but they will get a better quality trade. Because when the candle is formed once at 4 o'clock, firstly, and the movement is longer, and secondly, the signals of technical indicators will be more accurate. I don't recommend trading 1 minute and 5 minute trades because there will be too much market noise, too many wrong trades, and too many sharp moves that will cross the super trend in either direction, giving a false signal. Optimally, an hour, but you can also test the strategy on 15 minutes and 4 hours. Time in general is a very simple strategy, and I recommend you to try to measure the results. If it suits you well and brings you good results specifically for your trading style, then you can use it for your work.